What is going on? Welcome to the Hidden Edge podcast, episode 31. We're going to have a latecomer joining us soon, Mr. Kris Patel, but I will get us started. Just wanted to kind of go over some charts, a little bit of data that's been coming in, where the Fed funds futures is. But in case you've been living under a rock, the market has pulled back pretty considerably today in light of the quote unquote sell the news event for the NVIDIA GTC event, where NVIDIA came on and they released some pretty crazy products for like the next few years, actually through 2027 to be specific. And honestly, these GPUs are just going to they're just going to keep pumping out GPUs like it's a new iPhone every single year. And it's going to be the best of the best coming out. No one can literally touch NVIDIA when it comes to accelerated compute, especially GPUs. In addition to having their entire proprietary software behind it with CUDA. And on top of that, they're releasing the NVLink, which is the network segment that connects all the GPUs together to create an entire cluster. It's just a monstrous set of products that they're constantly releasing. And I know a lot of people are bullish AMD, and honestly, AMD is still going to be relevant to this day. But at the end of the day, NVIDIA is the leader, and they are the best of breed, and they are not going to stop. They're not going to take a deep breath. They're not going to take a year off or anything. They're going to constantly release the best products every single year, no matter what, and there will always be a buyer for all these products. Keep in mind, guys, you might not be at home thinking, hey, I want to get the latest NVIDIA GPU that's coming out next year. But a lot of these hyperscalers are going to buy them no matter what, because they're going to need to make them available for their clients. There's always going to be clients out there who want them. Now, the demand is a question mark as to whether demand is still going to stay as strong year over year. But the Hopper is still a very strong GPU. With DeepSeek coming out recently, it pretty much showed that you can do a lot more with a lot less. But that doesn't necessarily mean that the new NVIDIA GPUs are not going to be of any use, because there will always be use cases where the best of the best companies in the entire world need the best compute. In order to get the best compute, they have to pay up. And when they're paying these hyperscalers for that compute, the hyperscaler is going to be paying NVIDIA for the newest, latest, and greatest GPUs. So, you know, that for me personally, I think the new theme is Broadcom as well as the network segment with the communication of packets and data between all these GPUs, and also all the data between servers in the data center. I feel like that's the next bottleneck when it comes to this entire AI theme. But on top of that, you also need to work on the software as well, because the software could possibly be a bottleneck, leaving a lot of that compute not being utilized fully to the 100%. And we've seen that with the DeepSeek benchmarks that was shown in the last couple of months, that certain models are able to utilize that compute to 100% utilization while not using as much compute as people would expected with, let's say, Blackwell, the GB200, and so on. Not saying that they're not going to be relevant. They're definitely still going to be relevant. So before we jump into a bit of the tech stuff, I wanted to take a look here at the CME Fed Funds futures, because something that was pretty interesting, guys, was that, I mean, if you got the Fed Funds futures, what was it, back in the beginning of 2024, the market was definitely pricing in about 6 rate cuts in 2024, and we only got 4. Today, what they're pricing in for the end of the year, so this is the December contracts, they are pricing in the majority percentage of only 2 rate cuts by the end of the year, and that's a 33% chance. And you could see here, going back about a month, it's been pretty constant. A month, it was about 30% a month ago. Something interesting here is that there's now a 28.6% chance of getting 3 rate cuts, and that was 12% about a month ago. So I think that this is going to continue ticking up as data comes in, showing that the economy is, I wouldn't say slowing down to the extent that we're going to get another recession, but normalizing. I mean, we've been running on basically Celsius energy drinks in 20 and 21. And then in 22, I think we had a recession in 22, because by definition, 2 contracting quarters of GDP does mean a recession. But I don't know, the economists thought differently, and they decided not to call it a recession. Maybe some money got slipped under the table for someone. Who knows, guys? But at the end of the day, I don't think we're heading for a recession, but I definitely think we're normalizing here on these charts. So one thing that's actually pretty interesting is that for the next Fed meeting after tomorrow, of course, tomorrow's a Fed meeting, and I bet my house that we are going to get a rate cut as far as data comes in today. Now, you guys know what happened last September, all right? Coming into last September for that first rate cut, the market expected 1 rate cut. And then Friday before that, a Wall Street Journal comes out, and all of a sudden the market start pricing in 2 rate cuts. This is tomorrow. Okay. So if I'm wrong, I lose my house. I'm not gonna lose. If I'm wrong, I'm not gonna lose my house. Okay. Like no one's gonna hold me up to that. But I'm just saying that there's 100% chance we're not gonna get a rate cut tomorrow. So if anyone wants to go on Cal Sheet, whatever it's called, and put their house on the line, that's gonna you could probably buy like 1 million houses, probably more than that if you're right. If Jay Powell comes on there and cuts rates, you're gonna be right. So it's up to you if you want to take that bet or not. Personally, I have a bad distaste for taking the other side of a bet and then losing money on it, the election. But I mean, it looks like here that is definitely going to be a pause tomorrow. So for the next FOMC meeting on May 7, there is an 83% chance we're going to pause rates. Now, what is happening behind the radar? Okay. A lot of this is really based on data that's coming in. So as data comes in that shows more slowdown in the economy, you're definitely going to see the chance of a rate cut in May 7 increase. I think we're going to get anywhere from 4 to 6 rate cuts. That's such a wide range. Or, oh, why is it 4 to 6 rate? Of course, you're going to be right at 4 to 6. Okay, you know what? 4 to 6 is a lot more than 2 to 3 right now. And I definitely think we're going to get somewhere between 4 to 6. So we could get 4, 5, or 6 rate cuts. But at the end of the day, if we get more than 3 rate cuts, or actually if we get 3 rate cuts, you better bet that those long-term rates, aka TLT, is going to rally. I don't know where it's going to be by the end of the year, but definitely a bit more upside from here, in my opinion. And at the end of the year, I already told you, you got a 33% chance of 2 rate cuts, and you got about a 30% chance of 3 rate cuts. So that's where we are sitting. All right, let's take a look at the chat here. Yes, we live. What's going on, everyone? Let it snow. Let it snow. Let's out. Why is everyone saying let it snow? I don't understand. Anyways, appreciate it, Matt. What's going on, dude? Yeah, so oh, okay, well then that's nice. So I think someone asked me a question. Yeah, can you rank the mega caps? I don't know. That's kind of, do I really want to rank the mega caps? Because I'm going to be like, oh, okay, so last place is Tesla, and then 1 month from now, Tesla's going to be number 1. So who knows? In my opinion, though, I think that what do we add? Actually, you know what? Let's take a look here. Let's take a look at some charts while we're at it. Bring up the screen here. All right. So we got the charts here. And then let me take a look at my mega caps over here. All right. So we got the performance of these companies, and let's get the performance one. All right. So we got Apple. How's Apple doing year to date? Oh, I got to bring that percentage over there. Okay. Oh, I got to bring this over here. Great. Hold on. Bear with me, guys. There we go. And I'm on percentage. And then let me turn this to a line. Boom. Okay. So year to date, Apple is down 13%. Year to date, Amazon. I'm actually kind of surprised that Amazon and Apple are down about the same amount year to date. You know what? Is this the year to date? Come on. Is this the year to date? Yeah, this is the year to date. Wow. Okay. I'll take that. Google's down 15%. Meta's down 3% year to date. Is that for real? Can someone fact check TradingView? Someone fact check this thing. In the meantime, let me continue going through the charts. 9% down on Microsoft. Netflix is up 5%. The streamer, the number 1 streamer of the entire world, is up 5%. I wouldn't actually classify Netflix as a mega cap. Is it even a mega cap? Yeah, it is. Yeah, it is a mega cap. It's $400 billion. I mean, I think this is a growth stock, in my opinion. Not so much a mature, because when I think of mega caps, I think of like a more mature company. But when I think of Netflix, I don't think they're mature at all. I think they're definitely going to do well. I mean, they're the leader and the innovator when it comes to streaming services. So they're definitely doing good when it comes to that, since a lot of linear TV, which is like turning on the TV and watching channels and stuff, no one really does that anymore as far as subscribing to cable. And Netflix, at some point, Netflix is going to get into the cable game. You've already seen Google TV get into it. You've already seen Amazon. Actually, no, Amazon hasn't got into it. You see a bunch of names like Fubo. So Disney is going to take a stake in Fubo and so on. Netflix hasn't yet. So we will see what actually happens with that. Netflix aims to partner with UFC. Yeah, I mean, well, actually, Isn't the UFC guy part of the board at Meta now? So maybe there's going to be a little bit of disagreements there. I don't know. Maybe they're going to have a partnership. Who knows? Tesla is down 40% year to date. Okay, well, how much is Tesla up in the 1 year? It's still up 30% in the 1 year. So if you bought Tesla up here, I don't know what to say. You're definitely chasing it and you're holding on for too long. What is NVIDIA up year to date? NVIDIA is down 16.5% year to date. Netflix is going to buy it. No, they're never going to allow that. Disney will never sell themselves. Maybe they might sell. If they do sell something, no, they're not going to sell their streaming arm. Because I was actually thinking maybe they might sell the streaming arm. No, they're not going to sell the streaming arm. I mean, Disney's cash cow are the parks. I don't think Netflix wants to manage that. They're purely an online platform. So I don't think they're ever going to do that. So in my opinion, ranked 1 to 7 in terms of the mega caps, I would say Amazon is definitely number 1. I mean, I'm very biased when it comes to Amazon. This is my number 1 position in my entire portfolio. I've been long Amazon for quite some time. I will continue to buy Amazon every single DCA, whether that's a very small amount, $5, or whether it's a few hundred, whether it's $1,000, whatever it is. I will always continue to buy Amazon whenever I DCA. Google, is it the number 1 mega cap? Maybe not, but I definitely think there's a lot of value in Google. This thing trades at about 15 times forward PE, anywhere from 15 to 16, 17 times forward PE. You know, Google was actually pretty interesting this morning. This thing hit a nasty low this morning at 156. Can you believe that? This thing hit 156. Hey, what's going on, dude? How you doing?
Good, man. Hold on.
Oh, you got to turn on your, guess what mic there. Yeah. So, yeah, Google is at 156 this morning. When I saw that, I actually didn't notice it until later on. That is nasty decline in Google. I don't know. These algorithms are ruthless, man. They will sell anything. They will sell anything right now. Seeing Google at 156, I mean, I didn't get a chance to buy it that low, but I have no problem buying Google today. Meta, I think they got a lot of runway. They got a lot of runway for sure.
Dude, what's going on with your mic? I think you're clipping. At least that's what I'm hearing. Is it okay?
How about now? Am I clipping, guys?
Much better. Much better.
Okay.
Yeah.
Hey, your mic is on. It's not on your microphone. It sounds like it's coming from your laptop.
Okay, give me 1 second. Audio. Let me rejoin.
Oh, better. It's working.
Yeah. Okay. Great.
My brother just texted me. Features are so funny right now. Oh, wow. I mean, you know, we've seen action like this and then swing the other way. So we'll see what happens. But my brother just texted me saying that futures are crazy right now. So we'll see. Anyways, what's going on, man? How are you?
Dude, every day I'm waking up and it's like either dark red or dark green. So the volatility is just all over the place, you know.
Today was not dark green, that's for sure. It was dark, but it wasn't green.
Yeah, I mean, the challenge is there's so much uncertainty into the markets that people are trying to bottom tick things. People are like trying to sell off tops. So it just keeps this giant move up and down. And it's one of those things that you just have to kind of like live through right now and just survive and make it past this point of volatility. And then after that, you can actually pick up real value companies. So here's the challenge that I'm seeing right now. There is so much policy uncertainty because like companies are, on one hand, there's like, oh my God, like we don't know where the economy is going to be 12 months from now. So we don't want to make capital investments. But then at the same time, you're seeing data that's come out that's showing inflation slowing. So then when people see that, they're like, oh my God, I need to buy this dip because that means that Fed rate cuts are coming. And then like new data will come out and say, well, maybe, you know, things are not as great or things are actually a little bit better. And so now that possibility of that Fed rate cut goes down again. And it's this right now. And that's causing the market to just keep going up and down. So
well, we'll see. I did go over the CME Fed funds futures data. I mean, we're still between 2 to 3 rate cuts by the end of the year, which is very appalling right now, considering we already had 4. and that would mean they have to slow down dramatically. But I do think that coming into FOMC, I think they're going to stop the QT or letting bonds roll off the balance sheet. I did come across this chart, which is pretty interesting. By the dip reigns, third largest weekly inflow to equities ever from GWIM clients. So this is basically B of A clients, but they're taking data from them. So we had the largest inflows, or the third largest inflows ever. This goes all the way back to 2012, following one of the largest outflows the week prior. So last week was the biggest dip buying they've seen in quite a long time. So, I mean, it's not just what we're seeing in terms of sentiment in the market where people flip-flopping, but we're also seeing the data too, man. I mean, this is not, unless B of A is lying, which they're not. B of A is not lying. They're very credible. This shows that even the money managers are still unsure which direction this market is going in. So we'll see, man. We will see. This just shows that a lot of people are getting chopped up right now. But yeah, no, I agree with you. I mean, it's now's an opportune time to buy some companies while they're a lot cheaper. I did go over the Google chart. Wanted to get your intake because someone actually requested it. What are your thoughts about the Wiz acquisition?
I think long term, it's pretty good for them. I mean, from what I'm seeing and what I read about the Wiz, they are cloud native security. And one of the things that we're going to always see is this need for cybersecurity, more so in the future because of AI. So Google's making that investment now. They see this being the best in breed service that's going to help them grow their GCP business, which is now profitable and generating operating income. So the thing is, if you want to take market share from Microsoft and from Amazon, you need to create something that's a little bit more palatable for you to basically expand, right? So you need differentiation. Now, yes, I get that the Wiz is multi-cloud, but when you're, let's say, Google salesperson and you can bundle things into your offering, right? You're basically going to say, well, maybe I should use more Google GCP than I need to use some of the other ones. So everyone is going to adopt a hybrid. Well, not everyone, but most companies are going to adopt a hybrid and multi-cloud approach in the future. And I think having the best in breed software that can, provide a nice security blanket around your data stack is probably the way to go, especially now with AI, because before, when it came to, hacking and everything else, it was a little bit more like, difficult process. But now with AI, you can create malware really quickly and actually do multiple, a lot of things like in a very accelerated pattern. And so in order to basically mitigate from that, you're going to need it. The other thing is, from an insurance standpoint, you want to make sure that you're working, because remember, all these companies, they're going to need insurance, right? So the insurance carriers are going to say, well, what kind of data stack do you have protecting you? And if you don't have like the latest and greatest thing, and this rings true for any cybersecurity play, whether that's like CrowdStrike or Zscaler, Palo Alto, you're going to need a very, very strong platform behind you that's recognizable to the insurance company so that they will insure you. Otherwise, you're going to be in a not so great place. So I think Google's playing it smart. I think their acquisition is actually going to be value accretive probably 5 years from now. And Google has the money. They're sitting on the cash. So it's not like they're taking on a ton of debt at high interest rates to finance this. This is not like MicroStrategy, where they basically just issued perpetual preferred equity at 10%. I am shocked by that. And all they're doing is buying Bitcoin with it. So, this is a company that's going to help them generate value in the future and generate tangible revenues and income. And the pace at which they're growing right now, if they can sustain that growth level for, I think, at least 5 years, then this will be just like a very small payment for future market share gain.
Just have to wait a couple of quarters and then they'll pay them.
Yeah,
just wait a couple quarters and then we'll give you a paycheck. Like give a couple quarters, Wiz.
Well, one of the first things is it has to get through FTC, I think, right? So there's still going to be some antitrust issues that Google is going to have to deal with. But there's other cloud providers out there. There's other security companies out there. So I don't know. And not to mention, Google tried to buy them last year for 23
Yeah.
and they didn't go
Yeah.
for it. You know,
Well, I mean,
I wonder.
I don't think that they didn't go for it. Wiz denied it, said they're worth more, and then they said they're going to go IPO. They never actually filed for IPO, but they said they're going to. So now, here's the interesting thing. Okay, so when I heard this announced, I actually went out and I bought more Sentinel-1. Okay,
Yeah.
and the reason why I bought more Sentinel-1 is because even though Wiz is more focused on network security, but it's still cybersecurity as far as the market's concerned. Wiz is valued at 32 billion, right?
Yeah.
Their ARR or annual recurring revenue for ending this year is actually 1 billion. So that let's just say their revenue is $1 billion, okay? Because that'll probably be the most important metric. They're growing at about 42% per year, right? So that means that Wiz is trading at 32 times, and this is assuming balance sheet is, neutral. So even cash, even cash, even debt, 32 times EV/NTM. CrowdStrike trades for, well, now it's like about 21. Okay. So just the other week, they were at 300, and that's when I was buying them, and they were like 17. Now they're at 21, and now I'm probably not going to buy them. But Sentinel-1 is at like 5 times right now, 5 times EV/NTM. Sentinel-1 is growing about 27%. They did guide for 25% next quarter, and they're a much smaller player, and they're focused on small business and medium-sized businesses. They do have enterprise customers, but not like CrowdStrike. CrowdStrike has almost all the enterprise customers, about 42% of all the cybersecurity clients around the entire world. So Wiz is like, I want to say the leader when it comes to it, but they're very fast growing, and they offer a very competitive product, not directly competitive with Sentinel-1 and CrowdStrike, but Google is planning to acquire them. So now seeing Google get into the cybersecurity game, especially with a $32 billion valuation for this company, 42% growth is no joke, but at the same time, it just shows how valuable this industry is.
Yeah.
So since they actually posted, if you look at CrowdStrike today, and I only attribute price action when it follows like big news like this, CrowdStrike was basically flat today. Okay. In fact, since their earnings, they're low the other week. So we had the low on Thursday, right? So they're like around $300 on that low. And then since then, they're up like 20%. So someone knew that this was coming, right? Especially considering all the earnings that I've seen from cybersecurity, they're all, besides CrowdStrike, they're all still guiding strong performance next year across the board. There is talk about IT budgets tightening, but that's mostly for Sentinel-1. But at the same time, Wiz is a lot of enterprise security, so they're not going to feel the heat of that volatile IT budget. So in my opinion, this just further cements my theory that cybersecurity is probably one of the safest growing secular trends all across the board. Of course, it's accelerated computing with like NVIDIA GPUs and network computing with Broadcom, A-Lab, and Marvell and whatever. But when it comes to cybersecurity, it's like they're all going to win. Because it's like the one budget that companies usually don't cut. Because like cutting cybersecurity is like saying that we're gonna downsize our military for our country, which
your insurance will go up.
Yeah.
Your insurance will go up. So if your insurance goes up, then whatever savings you thought you were gonna save is gonna get negated anyway. Not to mention, all you need is one massive disruption, and that's it. And especially if people get into your database. If people get into your database, like you were talking about, what's that company? Rubrik. About a company, a hacker getting into your database, copying your database, and then encrypting it and locking you out. I mean, at that point, you're pretty much effed, So
this is happening at United Healthcare.
Yeah. So it can really, really impact people in a really bad way. So,
Yeah. And it's not only that, but like, it's not only being in that situation that you're going to get screwed. Cause like, let's be honest, United Healthcare can afford $50 million. Like that's just nothing to them, but the credibility, also all the compliance they got to go through after that. Like you think it's like, oh, we have to up $50 million. Oh, well, like first of all, they're going to get fined a lot. They're going to continue to get fined. And second of all, a lot of people are going to switch out of United Healthcare. And third of all, a lot of those teams that are working, especially in IT, they're going to be forced to stop doing real work and then do more compliance stuff, which is going to take away from advancing their own product. So this is like probably, well, this happened more than a year ago, but it's probably still hurting them to this day. And I think since then you had a lot of executives step down. I mean, I know that whole thing happened with one of the executives getting murdered, but at the same time, it's like, dude, especially in healthcare, like you got to protect that data, and they will spend to protect it. S might be yeah. You know what? Actually, the funny thing with this was that there actually were rumors of a buyout, probably back in 2023, and then those rumors were negated when Tomer, the CEO, he basically said we're not for sale. But I could see that happening now, especially this valuation, and especially seeing the value of cybersecurity today. I could see them getting bought out at some point. I don't know who, but definitely at some point.
Yeah. All right. So outside of that, someone was asking, can Google keep doing its share buyback? Dude, they generate 100 billion in operating cash flow. They're fine. They have this isn't even like chump. This is like chump change for Google. I mean, we could take a look just to clarify so that people.
It's just a few $100 billion, dude. It's not a big deal.
To Google, who generates, I told you, $100 billion a year in cash, they are not worried about this. This is not even remotely on their radar. Well, I mean, it is on their radar. It's a lot of money, but in terms of like total value, look at this. Let me just share screen right here. So if you look at Google on a revenue basis, they generate almost 350 billion in revenue, gross profit of $200 billion, operating income $114 billion. You know, so if you look at this on a cash flow basis, they generated $125 billion in cash flow. You know, so even with their capex, like let's say right now it's 52, might go to 75, they've still got a crap ton of money left over for both share buybacks and other things. And not to mention, if you look at their balance sheet right now, they have $95 billion in cash. So Google's fine with another 52 billion in receivables. I mean, Google will be fine. No, I wouldn't worry. This is not something that Google can't afford. So don't worry about that. And they can afford the share buybacks.
Someone asked this question. Mandy, it's a bit different. They're mostly on cyber threat response, not necessarily like the active tool that's monitoring the network. So quite a bit different. But this just shows that Google wants to get into this game. So they're very serious about it. So that's a combined. So they acquired Mandiant for about 5 billion. So that would be about 40 billion in total for all the cybersecurity work, which is only half of their cash. But at the same time, I mean, they're investing almost as much in cybersecurity than they are in capex. So that's it. And that's an interesting thing that you showed on Google was the operating income is nearly $100 billion. That, yeah, like you said, that's after capex. See, Amazon's a little bit different because Amazon has a lot of capex besides, just investing in infrastructure. But I mean, well, actually, yeah, no, you got to look at the operating income. But when you think about free cash flow, I feel like that's like a different story because a lot of people look at free cash flow and it's like, well, then that's also including a lot of stuff that they're making in terms of capex, and you don't necessarily want to include that. Like, I don't know. I feel like when I'm looking at operating income, like it gives you a good idea about the business, not necessarily like all the financing and all the investing income and cash flow.
Yeah, and if you look at Google's like just cloud segment, their cloud segment's operating income right now on an annualized basis is 6 billion, right? So it literally went from like last year 1.7 to almost 6 billion. And if you look at just revenue by that segment, it's one of their fastest growing segments. So they're going to do everything they can to keep growing this. So literally 4 years ago, it was 9 billion in revenue. Right now it's 43 billion. So anything that they can add to basically to the value chain to make this number go up, but then also charge, they can do that. And right now Google has huge list of clients. So it's not going to be hard for them to sell this, as an additional expense. So I wouldn't worry. Like I said, right now they're generating almost $43 billion in revenue from their cloud segment. And if you look at their profitability, which some people, by the way, I had no idea thought that Google Cloud could never be profitable. And I'm like, yeah, okay. This is why they got TK from Oracle, man. You know, they paid him well, but the guy is a freaking beast. So
almost
yeah.
anyone from Oracle is a beast, man. I mean, Oracle, especially training the executives there, like, you guys got to remember, Oracle was like one of the first pieces of software out there with PeopleSoft. Okay, they transitioned a legacy human capital management system into a fully functional piece of software that can be synced across the entire organization. Like, they changed that entire industry.
Yeah.
So think about Salesforce. This is why I don't think Salesforce is going to go anywhere. I mean, I don't know about the return, but Salesforce created the first customer, what is it? CRM, customer resource, man. I forget what CRM stands for, but they were the first ones to do that, to basically take the entire database of all the clients and everything and put it all together in order to process that data and present it pretty basically to anyone in the company or anyone who has a seat in Salesforce. And they're so cemented in so many applications, is that like to transition out of Salesforce is way more expensive than just keeping it. And, you know, honestly, the same thing goes for Google products. It's like, think of the developer community that uses Google, especially a lot of the code and the platforms that they do create. Like, how are you going to switch out of that? You can't switch out of that. They basically built the entire backbone. So
yeah, this is one of the guys that's like the leaders that's responsible for a lot of the stuff that Oracle had. So as president of product development, he oversaw 3,000 odd product development efforts, including Oracle database, which is huge right now, Oracle Fusion, ERP, CRM, and supply management applications. Like, bro, this guy was the guy. Like, he could have, I honestly believe he could have succeeded Larry Ellison as CEO. I think right now is Safra Katz, right? Which is good too. No, who's Safra CEO Katz, of who's no, I think she's the, is she, or
she's the CEO, but Ellison is the CTO, but he basically owns the majority stake in the company, though.
Gotcha.
So, she's just part of the board. Isn't that funny? It's like Safra is technically his boss, but as far as owning the company, like, she's got to answer to him. So it's like,
that's how it works, man. You know, I think people don't realize that the CEO is definitely like the face of the company, but the ultimate decision maker in the background is the board of directors. And the thing is, whoever the chair of the board is really is the true leader of the company. People don't realize that. People tend to just look at the CEO and it's like, okay, that's the person that sets the tone. And it's like, he or she do set the tone, but the chair and the board are the ones that basically like put the guardrails around the business so that this way, you know, you can let the CEO run free or you can temper them back. So they're ultimately the ones that are like the gatekeepers. So,
So here's another interesting fact. Let me actually go here. Okay, so I'm going to share. This is one of the reasons why I'm very bullish Rubrik. And, you know, we had like so many things that we were going to talk about during this pod, but it just like, this is where conviction comes from. Okay. So let's see, where is the guy? Oh no, board of directors. Okay. Do you guys know who this person is right here?
No.
Okay. John W. Thompson. Let me click on this. He is the former chair of Microsoft for 7 years, 2014 to 2021. He is on the board for Rubrik. Now tell me how in any way this company cannot be successful if you have the former chair of Microsoft on your board. Oh yeah, also the former CEO of Symantec. So Symantec, well, it's not so much the major one anymore, but Symantec used to be, you guys ever seen Symantec installed in your computer? It used to be like the major cybersecurity endpoint client that people used to install on your computers. And then now you have CrowdStrike because like they're mostly cloud native. Symantec they are in that layer, but like, dude, you just can't compare them to CrowdStrike. But yeah, he's the CEO of that one. It's like, this guy knows a thing or two about cybersecurity. Okay. But I just feel like when you're doing research on a company, you want to see who's on the board. You want to see who's in management because that makes a big difference. Even the CEO of Rubrik, he's from Oracle. almost half of the people who work in the executive team in Rubrik were from Oracle. If you look at the best companies out there right now, most of them are from Oracle.
Yeah.
Not gonna lie, most of them are from Oracle. They're either from Oracle or one of the Mag 7s or whatever, but like they're mostly from there. In fact, here's the thing from Peloton, okay? That shitco that I am long, okay? Very small position, the shitco that I'm long. The CEO is from Apple. Okay, so it's like you got to kind of look at the big picture, okay? Don't look at just the price on a stock or the financials. Look at the whole picture, man. Put it all together. I trim my grab break even and put it into PayPal. Do you see that as de-risking? I don't know, man. I don't know if I put it into that's. I'm not saying that PayPal is not good, but
I think if your time horizon is long enough, PayPal will be value accretive. They're just doing so much share buybacks that the share price will eventually go up. Don't even worry about that.
Let's actually take a look here real quick, and then we'll move on to the next topic. And I'll even pull this for Google too.
Yeah.
So let me go to, I'll go to quarterly, and then weighted shares outstanding diluted. All right. So this is the amount of shares on the market for PayPal, just going down. As an investor, you are gaining more equity in the company. Well, not necessarily, but as far as the open market goes,
do a 3x resolution, make it bigger. I think that's up there. You see resolution, do 3x, see if it gets bigger.
Oops, I'm sharing the wrong tab. Here you go.
There you go. Yeah.
That's PayPal. The number of shares diluted is just going down, which means that your shares are being worth more over time. So they're going to continue doing this, man. As long as their price is suppressed, then they are going to continue buying back shares. Another one, Google.
Yeah, Google's got a massive share buyback program. I wish they would cut their dividend and just do share buybacks instead. Like the dividend's I'm not like they're spending $7 billion in dividends, and I'm like, who gives a shit?
And the the dividend. I was thinking something else for some reason.
There it is. Yeah.
All right, you have it there too. As a shareholder of Google, your shares become more expensive.
Gotta make it bigger.
They become more expensive over time. This guy says Peloton wrong, and he spelled Peloton wrong. Come on, man. All right, so all right. Next on the radar. So I went over FOMC. All right. So do you want to talk about
housing?
Yeah. Okay.
I think we're really gonna need to dissect housing. I think we could get into some real long-term challenges with housing in the next few years. And let me explain why. There are some key demographic changes that are happening around the country right now. And I think the number of homes coming on the market is starting to accelerate. And if it gets into a position where basically sales are, looking really bleak, there's going to be a lot of price cutting. And a lot of the data that I'm seeing, you're starting to see, let me just hold on. Give me 1 second to just show you some data points that are worth looking at. Here it is. So this is this data has been compiled by this guy, Wolf Richter. He is a bit of a perma bear when it comes to housing. So, take some of the data with a grain of salt, but a lot of the data that he presents is like factual data. So if you look at certain parts of the country, you're starting to see massive declines in price, right? So the top of the list is Austin. You can see at the peak in Austin in 2021, it was the average home sold for like 550,000. It's gone back down to like 450, and it's actually in negative territory. So if you look since the year 2000, the price of homes in Austin are up almost 290,000. I think the median income hasn't gone up nearly as much. I think median incomes have doubled since then. But if you look at the price of housing, they've tripled. So right now you can see this giant wave moving down as inventory. And you can track this because inventory in Austin has absolutely exploded. San Francisco, same thing. San Francisco is always, in my opinion, a little bit, pricey. But at the same time, it's kind of like starting to like even out a little bit. So San Francisco, supposedly around that area, you could buy a home for the same price as you did kind of during 2021. On an average basis. There were a time where it really went up more, but basically it's flatlined. So year over year, it's down 1.6%. Phoenix is down 2%. So you can see here during the first housing bubble, houses went from like 160 to almost 300 and then came back down. And then now you can see they're literally at 450,000, right? So since the year 2000, they're up 145%. I don't know what the median income in Phoenix is like, but you can see since its peak in July of 2022, it's down almost 10%. San Antonio, 8.2%. Denver, about 7.2%. Sacramento, where's Sacramento? Yeah, Sacramento, 7.2%. So a lot of this data is going to start making its way into the what is that thing called, into the readings in the next couple of years. Like Tampa is just right now, I know Tampa is really bad. Like the amount of homes that are in the market in Tampa is gigantic.
Florida's getting slaughtered. Florida, Texas getting slaughtered.
Nashville too.
Yeah.
Nashville is
anywhere people had an exodus going to, as far as the destination goes, they're getting slaughtered. Because people are realizing I don't want to live here anymore because there's too much inventory in the market. Because slowly people are like, I'm going to go back to LA. I'm going to go back to San Francisco, whatever it is. And there's too much inventory.
Yeah.
Way too much inventory.
Look at San Jose, though. They will not build new houses in San Jose. So everything, and they've got tech over there. So look at that. Yeah,
Silicon Valley. You're never going to, there's never going to be very hard to
get. So
pretty much all the rich people out there, they're never going to, I don't care. I don't care. Just buy me a house. I don't care.
Yeah. So if you look at the inventory, like in parts of the country, like it's starting to make its way higher. So U.S. housing inventory. So if you look at the active listings, it's starting to go up. Now, here's something that I learned over the weekend that I did not know. But did you know that there are a lot of people who have really good mortgages, but have not been making their mortgage payments? And instead of that data getting presented as, hey, look, this person's not paying their mortgage, they're going to get foreclosed on, there have been COVID era protections in place to allow for constant modifications, right? Where basically what's happening is, okay, now imagine this scenario, and it's an actual scenario. You buy a house and you stop making payments for the next 3 months. The servicer will call you at home and say, hey, listen, we can get you into a modification. What they do essentially is lower your mortgage payment by 25%. Okay. They take that and they tack the principal that you owe onto the end of the mortgage. And they tack it onto the end of the mortgage. And then at the same time, they don't charge any interest on the money that they've tacked onto the end of the mortgage. Can you believe that shit? And some people have been running this for the last three, almost 4 years.
I can imagine that there's some games being played just to keep it there.
Now, here's the thing that should shock people. How many foreclosures do you think happened in the US last year?
Probably a lot.
No. The number of foreclosures in the United States is like at this crazy low level, man. Foreclosures. Okay, here it is. 1 second. Damn it. I'm looking for more up-to-date information. Okay. This is from 22. Okay. So you see this right here, the foreclosure rate. In 2005, the foreclosure rate was about 0.46%.
Wait, can you zoom in?
Yeah.
There you go.
Here in the US, the foreclosure rate went from 0.46%, right, to almost 2.2%. So by 2010, it was almost like one out of every, one out of foreclosure. like 1 out of every 100 homes, and we have a lot of homes. So a lot of foreclosures came to market. Since then, because of like loan modification programs and everything else, the foreclosure rate has dropped significantly. And during COVID, it dropped to even lower levels because of all these programs. Now, the challenge that you run into, look at this, the lenders foreclosed on in 2022, almost 4,000 homes in the entire country, 4,000.
It's like nothing. That's pretty crazy.
Okay. It's not that the, yeah. Damn it. All these sites have like this crazy.
Well, is foreclosing your home the event when the bank forces you to auction your home off, or is it?
So this is actually a better chart to show. This is mortgages, right, that are 60 days past due. You can see here in 2012, it was about 10% of mortgages, they were past due. It spiked up to about 3.49 during COVID. And then now it's literally like 0.58. So you're asking yourself, man, does this mean that everyone is paying their mortgage on time in a timely fashion? No, that's not the case at all. There's been a few people on Twitter that have been talking about this. Let me just, and it's actually very interesting. Yeah, right here. Blah, 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 blah. Damn it, where's this guy? Not this guy. This guy is like a perma bear on housing. Like literally this dude's been calling for like the bubble to pop for like the last 5 years. So I wouldn't use his data.
There's a lot of those.
Yeah, but there is another person. Okay, I highly recommend this guy right here. John Kaminsky. He actually works in the mortgage sector, and he's actually showing the actual like loan level data that shows what's actually happening. And he actually gives a couple of examples. Let me just show right here. Okay, so like this is loan level data from Ginnie Mae that he was able to get. So if you look at this FHA loan that that basically this person got 3 years, 0 payments on a $620,000 house, and basically they've been able to take that money and put it towards the back, and they have not made payments. And instead of making payments, basically the servicers have been paying for them and tacking on the principal to the end of the mortgage. It's this crazy like protection program that like the Biden administration extended in 2024 as well. And so that's why you're not seeing literally the amount of foreclosures or anything, even as the economy went down the last couple of years, you know? So it's, and it's, hold on, let me just show you. FHA loan modification program. So all of these loan modification programs, it's called loss mitigation right here. So all of this right here, basically a forbearance plan allows borrowers to work with their mortgage service to temporarily pause or reduce their monthly payments and maybe provide specific terms for repayments. Now, here's the funny thing about this whole thing, okay? Do you think that like when you stop paying your mortgage and the mortgage servicer calls you and says, hey, haven't you paying your mortgage? Do you think that there's any sort of control process to get this modification or just hardship attestation?
I'm not sure. I mean, I've never really been in that situation where I even thought about it.
All people have to say is, I can't pay my mortgage, and these guys will modify it and give you a discount on your freaking payment. 25% off. Can you fucking believe that shit?
Man, that's...
And this is with a 3% sub-3 mortgage.
Yeah.
So a lot of people have been doing this. And then there's another couple of things that have been happening, which is a lot of people have been declaring homes as their primary address to get FHA mortgages because they're much lower, much lower down payments.
Yeah.
And basically running Airbnbs with them. That's another major issue that's happening. Well, the challenge is a lot of these Airbnbs are not nearly as cash flowing as they were a couple of years back during COVID. There's also a bunch of people who got something called a DSCR loan, where basically they give you a loan not based on your income or the ability to repay, but based on the cash flows of the property. And a lot of people will use these DSCR loans to basically expand their their real estate empire, quote unquote. And it's and right now it's getting to the point where if the economy starts to break, these people are going to have real major issues. And this is the first time in a long time where the price of the cost to rent is actually much, much lower than the cost to own. Usually it's the other way around, you know? So if you look at housing affordability, something is going to definitely is going to be breaking sometime soon.
Yeah.
So, yeah.
Honestly, just looking at the way the market is, because you've had like consistent controlled selling for the last month, right? Like I feel like there's never been like that flush. Oh, by the way, yeah, it was my daughter's birthday. So I left it up there. Plus Olaf is the man. So, you know, of course I got to keep it up there. So anyways, you never had like that flush, right? Like that capitulating flush where it totally flushes and then everything just comes back. Like it's just consistent selling over and over again.
Well,
there are like some crazy charts out there that are like, could just be the market front running something that's going to happen.
No, the thing is, we saw the last 2 years a lot of stimulus by the Biden administration. Okay.
Yeah.
And believe it or not, that's what made this whole thing worse. So, yeah, we got a couple of really, really good years in the stock market, but a lot of that was based on a ton of liquidity that was just pumped in. And right now you're kind of seeing the hangover effects of that. So right now, if you look at like the cost of home ownership, you need your family household income needs to be upwards of 124,000 to own to buy a median home right now, right? The average median income the median annual income needed is about, that people actually have is about 80,000. That is a huge gap between the two. Yeah.
This taking out the x-axis. No, go down, but don't show the x-axis. No, scroll up. There, stay there. Yeah. Listen, yellow looks like a Bitcoin chart before the beginning of the year. This is not a good setup. It's not a good setup.
Yeah. And the thing is, you can see one of the reasons why the affordability, these are like the different things. So right now, you can keep each one of these things and it'll show you what the reason for unaffordability is. So if you look at if it goes up, it means things are becoming more affordable. If things are going down, it means it becomes less affordable. One of the reasons why things have become less affordable is because of the mortgage rate. But then on top of it, you're also seeing the median sales price be making things very unaffordable, right? So the median sales price is one of the reasons why, but then you have like the mortgage rate kind of come in behind it. So the thing is, in order for people to even remotely consider buying a home right now, mortgage rates have to drop significantly, or home prices have to drop significantly, or a combination of both. The other challenge that's happening is also like property insurance in certain parts of the country are starting to get kind of excessive, to the point where things are becoming very unaffordable for people. So
mortgage insurance or property insurance?
Property insurance, insurance and taxes.
That just keeps going up because of the rates, though, because they have to charge you more premium to incur the higher interest rate for their arbitrage. So
so there are so many issues that are happening right now in the background that I think in my opinion, this is a perfect setup for a really, really bad hangover for the next 5 years. Now, what does that mean for us as investors? Well, I'd say we could enter into a period of muted growth. So the question that I have right now, and this is the question I've been asking myself for the last 30 days is, what is the economy? What is everything going to look like in 2030? And the real answer here is that we could see, and this is pretty much what happened in Japan. We could see almost like a lost decade kind of scenario if things don't play out how they're supposed to play out. Where you're going to see deflation happen. Okay. And Japan is a whole different beast because they have like a culture that just does nothing but save, save, and save. So that you know, I don't think we'll ever get to that level, but we could see some major moves downward in interest rates. And I think a lot of people are expecting, well, if as interest rates come down, more people are gonna go out there and spend and all this other stuff. And yeah, we could see a nice move. But if the economy doesn't improve on that, then we've got a challenge. So demographics wise, we got problems. So
check it though. So they actually revised their price targets in the last couple of months. And Oppenheimer, is bullish AF. The interesting one was that your Denny Research, notoriously bullish, from 7,000, revised their price target to 6,400. So that's nearly a 10% drop in terms of their price target. Goldman Sachs, 6,500. Now they're 6,200. So about a 5% drop. RBC Capital, 6,700 down to 6,200. So that's like about a 6% drop. These price targets are going to chase the market down. They definitely will. I think this might cause a little bit of downward pressure, but this is by the end of the year. So
yeah,
Stifle, I'm guessing they're notoriously bearish because they're actually below the price today. But the next price target is actually back to all-time highs.
Yeah.
The Tom Lee price target is so big that they didn't even have enough room in this chart.
Now, I mean, the way I see it, we've got a challenge with the Fed and with inflation and everything else. So inflation seems to be staying up so far, where right now core PCE is kind of like leveled off and it's not getting to that 2% target that Powell needs. And the thing is, the last thing they want to do is cut too soon. And then now they've got stickier inflation. So if you look at the inflation prints in September, they were going in the right direction, but then Powell pivoted, right? And basically cut things, and now things went down again. So you're getting to the point right now where the Fed may have to stay in the course longer than necessary, even if the data comes out. Now, in my opinion, this is going to cause volatility. So like tomorrow, summary of economic projections has come out. I think Powell is going to be a little bit more dovish. I mean, we all know that he's not going to cut tomorrow. So that's not even a question. The challenge is that what happens after that? And I think right now the Trump administration, they are staying on course with tariffs, and they're staying on course with getting the economy to slow down. And I think if the economy keeps slowing down, that will give the Fed more reason to cut. But the thing is, the market is going to deal with that choppiness in figuring that out over the next like few quarters. The challenge that I see happening is that because of that uncertainty, there's going to be people that are going to not put as much money in. And right now, with multiples being where they are, you're taking on a lot more risk. So instead, people are going to focus on kind of just wait and see. And I think that's going to cause some multiple compression, right? Where you're going to see companies that, like, let's say Google right now, that should be trading between 23 and 25, trade at 20 and 22, right? If you see companies that, you know, like other parts of the sectors, like they're not going to be trading at the high multiples that they've traded in the past. And, you know, I mean, we'll see. I still think that this correction could go at least another 5 to maybe even 10% lower than where we are today. And if that happens, then I think the market is going to basically force Trump to back off on his rhetoric, you know, because at that point you're risking a severe downturn, you know.
It's all right, guys. That's pretty much where we were last August, so it wouldn't be too bad.
Yeah,
we were just there August 5th. We were just there, so it's all right, guys. No need to run for the trees, but you're basically going to give back all the gains you had since August, plus more probably for a lot of people. But I mean, this one right here, this is the summary of economic projections from last December. So they're going to come out with this. This is going to be updated. This is basically the amount of people that voted for terminal rate cuts by the end of 2025. They had by the end of 2024, end of 2026, 2027, so on. So what they are seeing as of December was that most people think that we're going to be around 4% rates by the end of the year, which would mean 2 more rate cuts, less than 2 rate cuts, right? We're going to see this, and this is probably going to adjust down according to the market today. But I think it might be like closer to here,
Mhm.
but the market always undershoots it. So if that's the case, I mean they always overshoot it in each direction, but we're definitely not pricing enough rate cuts. And I don't know how the market's going to react if they do see that the Fed anticipates more rate cuts by the end of the year. But this is
I mean,
the big sheet over here. So this is the
here,
one that's they expect rates to be at.
here's my projections. I mean, going forward, I think they're being a little too tight. I think we're probably going to be somewhere around here by 2.5 by the end of 2025, and then after that closer to like 1.5, and then after that probably closer to like maybe 1 by 2027.
Wow,
Yeah.
that's pretty far down there.
Yeah,
Wait,
but
you're saying by the end of 2025, or you think that's what they're going to put in the dot plot tomorrow?
no. I think it's going to be by, that this is where we're going to end up.
Oh, that's where we're
landing.
going to go. Okay, no, that makes sense. They're not going to.
I don't think that
they put the
they're
dot
not
plot.
going to be
Everyone's
this
running for the hills. Everyone's running for the hills if that happens. Like we're going to be down like 4 or 5% tomorrow. We're going to reach your target tomorrow.
Yeah, I think the economy is slowing down a lot. I think housing is going to definitely take a giant crap. And once you see like shelter inflation and where that's going right now, let me just see. You can see that actually coming down significantly. So edit graph, index, change from you can see here on a 10-year rolling basis, right? Usually shelter appreciates about 2 to 3%, every year. So it's literally like inflation plus a little bit extra. That's why shelter does well. But then look at this move down. And right now it's at 4.24%. I think this is going to actually overshoot and go into like probably negative territory. And if this ends up happening where things actually go down below the standard inflation, this is going to like literally act like a giant anchor to CPI in 2026. Even after rate cuts, because I think as the Fed starts to cut interest rates, inventory is going to start to keep coming up because a lot of people have basically been sitting on homes that they want to sell. And to basically, throw the other theory out there, the protection programs that basically allowed for people to constantly roll over their mortgages, that's ending in February of 26. So yeah. So I think we're in a very different place next year. So yeah.
Very different.
Yeah.
Did you want to talk about Nebius?
I have no clue about Nebius, but I will say a couple of things. Do not touch CoreWeave. Okay. CoreWeave is not a great place to be. At least in my opinion, from the data that I'm seeing, it is a money pit.
Well, that's
and it's
certainly not what Jensen Wong wanted to tell people, but okay.
It's a money pit, dude. No, I would not be in CoreWeave. I think number one, you're competing against the hyperscalers. The products that you have are not the greatest. And basically you're like overflow for the hyperscalers. So I don't know, but if you want to talk about Nebius, go for it.
Yeah, I was going to talk about Nebius for a little bit, and just the preface, guys. I am long Nebius, but it is not a big position because it might go to zero. And the reason why I say it might go to zero is because it is a speculative cash burning company that will raise cash at some point, not a matter of if, when. Okay. And this is straight from the CEO's mouth. So before you get all bullish on Nebius, just know that this could be a multi-bagger, but at the same time, it is a speculative company to invest in. So now, when it comes to Nebius, let me actually pull up their. Hold on, actually pull up my Substack. Okay, Nebius. Oops, hold on. All right. So there is an AI value chain. And when you think about this, Oh my goodness, this is so big. Okay. So when you think about this value chain, this is basically where all the data centers are, GPUs, hyperscalers, and so on. Wrong tab. Here we go. All right. And the reason why I had green arrows here is because Nebius isn't actually in this chart. Kris, you just mentioned CoreWeave. They sit on the cloud portion because CoreWeave does, they loan out accelerated compute and GPU clusters, which is also what Nebius does. But Nebius actually builds these data centers all around the world, and they're growing at 400% plus year over year, according to last quarter. Their core segment, which is Nebius. So there's Nebius Group, which is the umbrella, and then there's Nebius, which is their core business. That grew about 600%. The entire company as a whole is not cash flow positive, and they are not EBIT positive. So they're actually losing money and they're burning cash. But they have about $2.4 billion cash on the balance sheet. But that is mostly taken from raising capital December 2024. And part of that was from NVIDIA. And they also sold off a bunch of their assets earlier in 2024. The thing you got to remember, though, is that, well, not really remember, because if you don't know it, then here go. Yeah, let me share this screen. So Yandex is basically it started out as a small internet company or search engine, started by the CEO of Nebius. And this was like 20 years ago, right? So he started as a small search engine, group blew up, ended up being like the Google of Russia, right? So as the Ukraine war started, there's sanctions being imposed on Russia and so on, and Yandex was actually a publicly traded company. And they were no longer NASDAQ compliant because of the fact that they had Russian assets. So they decided, let's sell off all of our Russian assets that will make us non-compliant to become compliant. And then that's how they were able to raise a lot of cash. And then they did another round of raising cash for investors, which is how NVIDIA came in, $700 million. So now they have $2.4 billion. But they sold off a lot of the assets that are Russian, and then they kept a lot of the assets in-house. So they have multiple products here. They have multiple businesses. And one of the businesses is AVRide. That's basically a full autonomy company for ride hailing and also delivery. They have like these little robots, like those robots that you see delivering food, mostly in like large cities and stuff. I don't know if you ever noticed it. Actually, let me see here. I'll share this screen. These little robots, right? So AVRide has a bunch of these robots all over the country and all over the world, actually. And they actually have multi-year contracts with universities and stuff. Like, this is a legit company, right? This isn't, some Russian company, whatever. No, this is a legit company that does this. And then on top of that, they do have autonomous driving vehicles that's based on LiDAR and vision. And they have a multi-year contract and partnership with Uber. And then they have for AVRide for their delivery, they have one with Grubhub. Like, these are actual legitimate businesses, and they're expected to, this business is expected to be it's not cash flow, expected to be break even by end of 2025 in terms of contributing profits, right? So the profit that is coming from this company into its core business, Nebius, is going to be profitable coming from AVRide. So AVRide is going to be a sustainable business. AVRide is also like a $50 billion plus TAM that it's targeting by the end of 2030. Take the word TAM with a grain of salt, or total addressable market with a grain of salt, because this is coming from the investor presentation that the company is providing. It is their job to sell their product and sell their stock. So they're going to make it sound really good, right? But even if it's $40 billion, still a wide TAM, especially for a $6 billion company altogether. So they pretty much are covering the whole ecosystem when it comes to robotaxis, last mile robot delivery, and intracity delivery with additional robotaxis and vans. And then on top of that, they're planning on tackling intercity delivery in the future by 2030, which is going to bring in more TAM. So altogether, this is about $60 billion, $64 billion. Okay. So that's one business, AVRide. Oops. Wow. Here it is. Okay. So they have another business called Toloka, which is a Gen AI data infrastructure. So Toloka is like, think of Fiverr, right? So Fiverr, you go onto the app and then you hire a bunch of people to maybe fix your rain gutter or install your dishwasher, or maybe even troubleshoot something on your computer, whatever it is. You can hire someone on Fiverr to pretty much do anything, design a website, anything. So for this is basically in-house outsourcing from Nebius, but they have this business segment called Toloka where they're basically doing Gen AI and AI related tasks, mostly for machine learning, LLM building. They have their own engineers in-house, and if they need to outsource, but basically they're like an outsourcing company where people come to them with like a problem they want to solve as far as training a model or developing some sort of AI application. They do it for them. And it's like more of a consulting company, but it's more of a platform that they allow other companies to visit, tell them what they want, and then they do it for them and so on. So it's a little bit different from like Accenture with their consulting company. This is more of like homegrown, and they're trying to make it vanilla for a lot of clients. They're actually planning on rolling out a self-serve platform soon, probably toward the end of 2025, where you could just like go in there, you can fill out a form or drop downs, whatever, and then you'll get it probably in like a couple of months or something, depending on what you're asking for. They're trying to streamline the entire process. So 80% of its revenue comes from classic Gen AI solutions. So like, you know, they had, I think this image is actually from their investor presentation back in October. So they've actually expanded this. I think it's like double the numbers today, but they're expanding on not only the classic AI, Gen AI solutions, but they're also expanding on the non-Gen AI. So right now it's 80% classic Gen AI, 20% non-Gen AI, and they're actually planning on balancing this out later on to kind of make it a bit more diversified. But at the same time, like this is going to become probably more important as time moves on, because companies will start to utilize more AI, LLMs and stuff. And a lot of companies are going to start training their own AI and stuff. And on top of that, Toloka actually, they do a lot of cross collaboration between their businesses where they're able to power a lot of the technology for Avride by utilizing their own in-house engineers from Toloka. So the CEO is having these companies collaborate with each other to build upon each other to kind of grow. And at the end of the day, they want all of these companies to bring all of their profits and their cash and feed it into Nebius. Nebius is like their core product. I'll get a little bit more into that one. Triple 10 is kind of like Code Academy or Udemy, where it's like an online learning education-based platform. This company, they're targeting a TAM around 95 billion by the end of 2030, and they're expecting it to accelerate at 26%, not accelerate, but they're expecting to grow cumulatively about 26% CAGR. So year over year, 26%. So I think it was like around, I don't know, like 20 billion or something today. And then to grow 26% is going to reach 95 billion by 2030. And this one is more of like an educational platform where people can come on there, learn, take a boot camp course or whatever, and then get a job after that. But they've been able to see good results where 87% of their students are able to land jobs within 6 months of graduating from that course and so on. Right now, they're focused on the US, but they do expect to expand further into Latin America to be able to expand that TAM and expand that addressable market that they can cater to. So you can think about the courses that are available online today. The courses are definitely going to expand to different learning levels or educational levels, advanced courses, basic courses, and so on, depending on your experience. And right now, they're mostly B2B. So they're signing contracts with major companies to be able to enroll their courses in here. But they're going to be expanding into B2C, where like anybody pretty much in the country who doesn't work for a company, they can go on here and they take a course. They can have a subscription where they can take any course they want to and so on. Very similar to a lot of the online courses out there, but this one's actually doing pretty well. And then finally, they have a 28% stake in ClickHouse. You might have heard about this one. ClickHouse is basically a direct competitor to Snowflake. They're an online analytic platform, but they're more of an open source model. But the way that they make money is that they have people who use their open source product, use their cloud product, where instead of the user managing their own ClickHouse analytic database, they're managing it for them. So that way the consumer or the client only has to worry about the data and the processing and the analytic processes between that and their own applications. So kind of like the same thing that Snowflake does, but this one, ClickHouse, is more catered to smaller companies. But this is actually growing at a very fast rate. And the interesting thing is that they own 28% of it. Altimeter actually owns about 15%. They both, ClickHouse was actually, they had a bunch of rounds, especially in 2021. It was a $2 billion valuation. They had a round where they raised a lot of capital from a lot of investors. Altimeter, I don't know if you guys follow Jam and Ball on Twitter, but he talks about this one a lot, of course, because their company owns part of it. So really, when you think about online data processing, Snowflake, MongoDB, Palantir, and so on, that's just going to be an ever-growing TAM, especially when you're dealing with LLMs that have to retrieve data, but not just garbage data that's on the internet, but actually process data that's used for analytical purposes. So this company is going to be doing pretty good. They have a majority stake in it, but at the same time, they don't necessarily run the company. They just have a stake and investment in it. So the bull case is, well, last quarter wasn't the best quarter. They did miss on the EBITDA guidance. However, they are guiding for anywhere from $700 to $1 billion ARR. Right now, the company is trading at, I think, $6 billion because they were down like almost 10% today on the back of, I guess, the anticlimactic NVIDIA GTC event. I mean, they're basically going to move with the entire market when it comes to semiconductors. Go ahead, you're mute.
Did you catch that, by the way? I didn't watch it. I didn't get a chance to watch it.
I was watching it, and I mean, it's kind of like the same thing that they do every single year where I was actually talking about it before you joined. They do it every year. Like it's like releasing a new iPhone, but these are GPUs and this is accelerated compute, right? So they have to release a new product every single year just to be better than anything else out there and to offer the best solutions out there. And I think the way the market looked at it was like, oh, this is boring. Like, I mean, who ever thought these GTC events were even fun to begin with? Like, this is a bunch of engineers displaying and demoing their engineering product. This isn't meant to be a Super Bowl. Like, do you remember how big this event was like 2 years ago? Now it's like people find it boring. It's like it is not supposed to be a fun event if you're not into this stuff. If you're a shareholder of NVIDIA and you don't know the first thing about GPU processing, don't watch the event. You're going to waste your time, okay? Because you're not into this. You just want your stock price to go up. Very different story. But anyways, they mentioned Nebius on there a few times. NVIDIA does have I think it's like about 1% stake in Nebius. So obviously they want Nebius to succeed. But remember, NVIDIA is a supplier of GPUs. Nebius is taking the GPUs that they get from NVIDIA. And keep in mind, if a company wants to buy a Blackwell GPU, they got to wait online unless your name is Microsoft, Amazon, Google, or one of the mega caps or Tesla. Nebius probably has a priority pass to the front of that line because NVIDIA owns them. They have a stake in them. So they want Nebius to succeed because they want to grow their money, right? They want to grow their capital. So they make sure Nebius succeeds. Nebius is growing at 400% plus, right? They are building data centers all around the entire world. This is the chart you want to see right here. So this is where they have data centers right now. And they're actually building a data center, 2 data centers in Paris and another one in the US. That's going to be powered by 22,000 Blackwell GPUs, right? So definitely not a small number. But according to Jensen Huang and according to reports, these are very high in demand. So people are going to need this compute. You know, whether you like it or not, companies out there need it, okay? Otherwise, they wouldn't be doing this. So where do I see Nebius at in a year or two? Okay. I mean, that really depends on the market. Are we just in a little bit of a correction right now where we're going to recover and so on? Is NVIDIA going to see new all-time highs and whatever? I think regardless of whatever these financials are, because they have $2.4 billion cash in their balance sheet, the company's worth about $6 billion right now. So half the company is in cash, but it's not like Grab, okay? Because Grab doesn't need to raise capital. Grab is a profitable business. Nebius is not. They will raise capital when they need to because these data centers are not cheap. They have to buy GPUs and then put in the labor to build these data centers. This is a very expensive thing, but management believes that the investments they're making today will pay off in the future. So we'll see what happens. They didn't guide for EBITDA profitability next year. They probably won't have it the year after that, but maybe around 2028, maybe 2027, they might be EBITDA profitable if this secular trend does continue. I think Nebius is basically a call option on AI, okay? If AI is not an SHIT show, Nebius can do very well because they're providing compute to a lot of major companies out there, including hyperscalers. They're providing compute to them, okay? They are leasing compute to these hyperscalers as well. They're competing with them, But these hyperscalers have so many contracts everywhere that they are providing that to them. The reason why Nebius is actually a company that's headquartered in Amsterdam. So whenever you see like Nebius NV or whatever, that's just a term for publicly traded company in Dutch, right? Most of their clients in the US, that's why they're building data centers in the US, but they're also building data centers in Finland, Iceland, and Paris. So that means they're catering to very high demand in Europe. So when you think about a lot of outflows going toward European technology, those companies in Europe, they want to have data centers in the US, but they also want to have data centers locally as well. So who do you think they're going to go to when they have the most availability in data centers to meet a high demand? They might go to Nebius. I'm not saying they will. I'm just saying they might go to Nebius. You know, like Nebius cannot compete with AWS or Azure or Google. They just can't. But as a smaller company, they can work very closely and focus very closely on these smaller companies that have high demands and set high bar for what they need, while AWS or Azure or Google would just be like, oh, here's the bill. Let us know if you want to deal with this. Nebius is like, oh, we'll work with you on your contract and we'll try to work with you to see what we can do for you, right? That's just like the nature of the reason why people go to regional banks versus big banks, because they usually get a better deal in regional banks. And the same reason why people go to mom and pop shops versus go to Home Depot, because they can always cut a deal with smaller mom and pop shops. It's the same case for Nebius. Nebius is not a mom and pop shop by any means, but they are definitely not as big as the hyperscalers. So they do have that advantage. It's like being a retail trader versus being a hedge fund manager. Oh, SPY's looking pretty weak right now. I'm going to buy some puts. A hedge fund manager can't do that without bringing down the market. But as a retail trader, you can. So that's kind of how you want to look at this. Okay. Again, this is not a big part of my portfolio. And if you buy into this, you need to go in with the expectation that is a speculative company. You might lose your money. But in order for that to happen, the risk reward is asymmetric, where you could make a lot of money, but at the same time, you could also lose your money. So I want people to have that expectation if they do their research and buy into this company, because anyone who tells you that this is a guaranteed win for anything, do not follow that person. Do not talk to that person, because of the fact that no one knows what's going to happen in the market. You could just set yourself for the highest probability of success. So that's all I got to say about that one.
I am staying away from data center plays only because I see a couple of things happening. Number one, the price, the amount of depreciation for AI products seems to be really, really fast. So, you buy these GPUs within one generation, they're not worth nearly as much as you bought them for. So the amount of depreciation is really, really high.
Buy a new car.
Yeah, it's like buying a brand new car and then literally depreciating really, really fast. And I think the amount of demand might have been a little bit overstated. And I think the whole thing with Microsoft cutting their like, did you see them cutting off like a couple of their leases for data centers?
Mm-hmm.
So in my opinion, that means that, yeah, I mean, there's still a lot of demand, but I could see even Google and some of these other guys eventually starting to moderate their CapEx spend going forward. And if that happens, then we got a problem.
Google did not give higher guidance for higher CapEx for next year or for this year.
Yeah.
Meta stayed flat. Amazon did increase their guidance for CapEx. Yeah. And yeah, of course, Microsoft decreased it. And then those news after that, like you said, Microsoft did cut off leases for data centers. So that risk is there. But I think the question you got to ask yourself is, do you believe AI to this day, to today, not years from now, because, it's like when the internet came out, right? It was a big hype. Do you think we are still caught up in that hype cycle? Or do you think that it's real and we're just going through a little bit of a weak period?
In my opinion, I think we might have overshot in the short term the actual demand for AI products. And I think the amount of money that's been spent on it has to get through like this digestion period, right? So a lot of this infrastructure has been built for X, Y, and Z. And I don't know about you guys, but I don't use AI like for everything in my life. like everyone projected. Like, yeah, I mean, there's software out there that has like components in there that, use certain certain AI features, but I don't think it's nearly as game changing as people think. Now, it's not to say that like in the next 5 years, it won't be a big thing. I think, you got autonomous cars, you've got robots, you've got all this thing. It's just the amount of money that's being spent on it right now might be a little bit ahead of itself. And that's typically what happens with, with these hyperscalers. And that was the whole thing that happened in 2021, where everyone was just hiring people because, it was like a war, war to get talent. Now I think it's like war to get AI compute. And I think right now people are starting to just like slow down and saying, you know what, we need to be a little bit more cautious with how much money we're spending.
Well, this is the thing. So, and I talked about this again before you joined. I wish you were in, but so what DeepSeek did was that they didn't kill the edge that the US had or the hyperscalers had in terms of providing AI compute. They just basically showed that you could do more with less, right? So I think that's the reason why we haven't seen new all-time highs in NVIDIA, because NVIDIA was portraying a lot of demand for the latest and greatest, and that wasn't necessarily the case. But the reason why I think software caught a bid was because, well, if software doesn't need the latest and greatest to do what they can with today's software, then we need to reconfigure and refactor everything so we can do more with the existing software. And Snowflake actually stopped buying chips. At least that's what Mike Scarpelli said. What was it, a couple quarters ago? So we'll see what happens in terms of buying chips, right? Buying more infrastructure and so on. I don't think that goes in line and in parallel with the amount of compute being used, because at the same time, even though the hyperscalers have built it out, that doesn't mean that it's never going to be used. So the life expectancy of a lot of their investments, like Andy Jass said, is that this is like a once in a lifetime event to spend this much money to build out the infrastructure. Because like Amazon did in 2020 to 2022, they were spending money out of their nose to build the entire logistics system that they still use today. So even though that's what people thought in 2022, that Amazon was going to go bankrupt spending all this money, dude, that's what they thought in 2007. And look at Amazon today. So it's probably going to be the same thing after this. We could be in for more pain, but this is the reason why I've said it over and over again. It's the reason why I'm not buying like crazy calls that expire for things that are high risk when it comes to AI and compute demand. I'm buying shares when it comes to that. In fact, I'm very concentrated in where I'm buying anything short-term, which I consider 2027 short-term in this aspect on. And it definitely is not like AI infrastructure. Okay. If I'm buying AI infrastructure, it's in shares, baby. I do not like, dude, if you buy, like, people who had like leaps on NVIDIA expiring in like end of the year are getting slaughtered if they started buying them at the end of last year. I mean, I'm not saying that I forecasted this happening, but like when the market basically goes vertical for 2 years, like what do you think is going to happen after that? Most of the gains has been reaped already. Like the market was up 25% for 2 years in a row. Like what do you think is going to happen after that? Do you think it's going to make another 25% run because the options are sure priced like that? When you buy options after a mega run, like if you look at the options on KWeb, dude, those things are crazy in terms of their volatility level. Kind of reminds me back of that crazy thing that we did. But I mean, that's just the nature of the game. I think personally that we are seeing it happen in ex-US. We are seeing money. You're on mute.
Which in hindsight was the right move. China was the play, right?
China was a play, yeah.
Yeah.
But I mean, we would have been flat. We would have been flat right now. So
I think that there's still a lot more room to run for China.
Yeah,
I think there's still a lot of, especially because liquidity is just being just started to enter the market. So I think consumer demand is going to eventually pick up, and when it does pick up, it'll China's a place to be, I think, this year. Believe it or not, I think even though it's up significantly from where we were, I think China continues its move up, and I'm cool with my position in it. So it's just kind of sad, man. It's kind of sad to see like the US going the other direction when China's going in the opposite
Yeah.
direction.
Dude,
But
I've told
it's
you before,
yeah,
the US won't come back if China's rallying. If China's rallying, the money's staying there and more money's going in there. And it's going to come from the US. Like there, unless liquidity is being injected in the system, which is not the case right now for the US, like there's only a finite amount of money in the
yeah.
US. So
US
it's going to
is
come from
literally
somewhere.
US is literally draining liquidity right now. China
Yeah.
and Europe are
Pumping
basically
into the
doing
system. Yeah.
deficit spending. So they're pumping into it. So where do you want to be? And I mean, I'm glad that we have positions in Nubank and Grab because they are going to benefit from a weaker dollar. You know, usually when you see like fiscal restraints like this, it goes in the opposite direction where usually the currency weakens. But right now, all the moves that are being made are kind of weakening the economy. So if you look at the Dixie's been on a multi
Yeah, I think
month
they're one
down.
now. Yeah. I mean, this is the reason why like you got to have a portfolio that's diversified, not only not only in the same sector you want to be diversified, but you also don't want to over leverage yourself or concentrate yourself in a particular sector that is just extremely volatile. I mean, like, dude, the volatile, the beta on like Amazon is way more than 1, which means that if SP goes down 1%, you're gonna go down more when it comes to Amazon. Like I don't know, you just gotta kind of know this when you're getting into it. You know, like people got so used to just the market just going straight up for 2 years that they think it's gonna continue happening. But at the same time, in hindsight, dude, Tesla's still up year to date. So it's not like wait. Hold on a second. Let me look at the chart again. No, the 1 year on Tesla, not the year to date. The 1 year chart on Tesla, it's still up. Okay. So if you bought in at like 400 plus, then you're probably underwater. But like, look at the big picture, guys. I'm pretty sure you all are still green for the last year. So,
yeah.
You know,
see, this is the thing to keep in mind with China right here. More and more stimulus is coming from China to basically get consumer confidence back up. And basically a lot of that money is going to be making its way. So think of China as there's a lot more room for China to increase its consumption, right? So if you look at 2023, it's literally one of the lowest in terms of consumption by the world. That means that there's a lot more savers than there are spenders. And the thing is, the only way you're going to do that is by bringing, a little bit, what's the word? Like a little bit of confidence back into the system. Now, how do you bring confidence? You basically pump liquidity into the markets. And I think that's what's happening. So right now you're going to see discount, you're going to see the Chinese consumer get stimulated, very similar to how we got stimulus for the last couple of years. And then, and China's already basically unleashed its tech sector, that whole thing with Xi saying, we're going to unleash the tech sector, bro. That's yeah.
One thing you got to keep with China is that right now, a lot of the rallying is happening in tech, but it is broadening out, I believe, when it comes to China.
Well, that's why I have FXI, man. FXI is the way to play this thing. So, look at this. FXI is up literally 30% year to date.
Yeah, no, China has been seriously outperforming this whole year.
Look at that.
I mean, that's where the money's going. So, you can't deny that.
The only challenge is, I think the 100%. Trump administration was trying to curtail some of the Chinese thing. China.
Bob is up 67% year to date. Is that insane, man?
Yeah.
Wow.
Yeah. So Tepper was right. China's the place to be, man.
Oh, actually, his 13F showed that he didn't sell. In fact, he bought. He bought more China. His 13F came out. Bought more China. I was actually very curious to see like if he sold the top or anything. And it's like, no, he bought more. He did the complete opposite. He bought more, baby.
I still remember when he was on CNBC. He was like, I don't care. Like they were like trying to call him out. Care. They're like, let me see. Hold on. Tepper. CNBC. Damn,
oh, by the way, look at this thing. Look at this thing. Look at this thing. Remember I pointed this out to you the other day? I was like, this is something we got to keep an eye on because this is starting to get me a little worried. Right here.
What's
Options
that?
adjusted spread.
Oh, yeah. They've been rising. That means recession fears.
Well,
I mean,
kind of
it's
pull
still
back a little
muted.
bit.
It's
Yeah.
muted. It's muted since if you go like do a historical chart, do like the last, so it's not like crazy levels of, hey, this is where we are, but yeah, it's getting there. It's starting to go up, which is not good.
If this breaks above the previous high, I'd be a little worried. But
Yeah.
I mean, we're so like, it's just, I know a lot of people think, including maybe you, that we're going to have a recession, including this guy too. We're going to have a recession. I'm not discounting that. Like, dude, the market could be down like 15% from here. Like, just everyone's got to accept that might happen. We have zero control over this thing. But, the probability of it happening, I don't know. I don't know. I don't think we're going to have a recession. I think we're just starting to see scares of recession, but I don't think we're going to have a recession. I think it's just all just normalizing. Recession has to be 2 consecutive quarters of contracting GDP. So if we get a negative print on GDP this quarter, we need another quarter. And then on top of that, they need to actually get together and determine that we are in a recession. So that takes time. And most likely, when they say we're in a recession, the market probably already bottomed.
Yeah. Another key thing to keep in mind. I mean, I know the guy in the comments, he seems like you're a little bit like really pessimistic, but you're also true. Like
You
right
could
now,
be right. You could be right. You never know.
One of the things that I've been tracking also is car loan defaults, which he's bringing up, which is absolutely true. Car loan defaults are literally at all-time highs.
Yep.
People are not making their car payments. And if car payments are not going to be made, that means, and let me just basically show you, hold on.
Carrying a record amount of credit card debt, not the only money we owe. Auto loan defaults hitting a record. Make ends meet. More and more car owners are opting for longer repayment plans. 2024, a record 66% of new cars were financed for 70 months or more. Despite the cost for many Americans, not having a car is just not an option.
People that on average are underwater, over $6,000 on their car loan, and they're rolling that into their next vehicle loan. And once that happens, it becomes a real hard cycle to get out of.
I wanted my car, I got it, and now I'm stuck with it.
Insurance, repairs, and tariffs are also threatening.
Look at this dumbass. She's looking for another car while she's already like stuck with one.
Oh,
like,
they just told her to do that. Dude, they just
calm your ass down, girl, if you're trying to buy another car.
No, get out of here, man. The news reporters just told her to do that to make it look more appealing and stuff. It's like, I'm underwater on my car payment. She's looking to Hummer.
Yeah, exactly.
What's
right?
small, girl? No, that's interesting. Guess, yeah.
Guess what people's debt to income ratios for the average FHA homeowner? 64%. Yeah.
I mean, it's cars are a good indicator for a slowdown coming, but like they're certainly not the cause of it. Cars are liquid, right? Like, so someone could just walk in a dealership and just sell their car. So house is a different story. You can't just walk away from your houses in 2007. They will track you down and your credit will be ruined, and they will sell your house, and you will be forever in debt, and they'll get a backing from the government.
No, man, come on. Look at this. I told you there's only 4,000 total foreclosures. The mortgage companies,
could come at once.
The mortgage servicers are basically saying, don't worry about it. We'll get you the next go. They're just, I'm telling you, all of this stuff, it's a crazy bubble, dude. It is, in my opinion, it's a crazy bubble. Like, we've literally lived the last 4 years of COVID stimulus, and I think we're dealing with the hangover now. People got money to stay, to work. People got money to just chill. People got PPP loans. People spent that money. People got mortgage, what is that thing called? Loan modifications. Student loans were paused. Yeah, student loans were paused for literally like years, right?
And the government covered the interest.
Yeah, the government's basically covered everything. Now the government's saying, sorry, we're not doing that anymore. And basically the consumer is like, okay, like, I get the unemployment is low. But if unemployment starts to rise and all these things start to default, we got a problem. Commercial real estate is starting to take on water, by the way. I don't know if you know that. Where there's a lot of things. There's a lot of buildings selling for under what they were bought for, and basically, yeah, I mean, it's a healthy market. That's just how things are. But the majority of deferment on housing payments haven't been paid, and many haven't made a single payment. Yeah, that's true too. So,
Dude, my SLG cell is starting to look pretty good now.
yeah, commercials.
It took a little bit of time.
Yeah.
It took a little bit of time, but finally below where I sold.
So this is deflation happening, man. So this is where I'd say we have to be a little bit more cautious. I think Google is fine. I think right now it's oversold in my opinion, but it could still get sold further down. So I'm thinking about taking the loss on the spreads and instead rolling them over into December of 2027 and basically
Wait. Let's not talk about
discuss this. Okay, we'll not talk about that here. Okay,
we're not doing anything. We're not doing anything.
That'll be on a Patreon. That'll be on that conversation will be on the Patreon. Yeah.
Let's not talk about that out here, man. What do you
Let's
think about doing Google? Oh yeah, Google's good. That's
yeah.
it. That's all I'm gonna say.
We should look at Venture Global. I think Venture Global is going to benefit from some of the instability right now. The only thing is, what is that thing called? The instability that's happening with the Middle East. Because Qatar is a major LNG producer, and they have to go all the way around the Horn of Africa to deliver gas to Europe. That's one thing. The Europeans are probably going to try to sign some long-term deals. So that'll be another thing to look at.
30 RSI. Amazon's 30 RSI. Microsoft is 39. How's that a 39, man? I don't get that.
Dude, look at Google. Google's RSI is
Apple's
like
like 30. Meta is probably at like 70. Oh, wow. Meta's actually at 30. I thought Meta was still pretty up there. Oh, whoa, they're at 582? I know they're under $600 again.
Yeah,
Nvidia's probably like negative. Wow, I can't believe Nvidia. Oh, yeah, they did bounce quite a bit.
Yeah.
Dude, Tesla's at like -5 RSI. Jeez.
Bro, everyone is keying Teslas and burning them and all this other shit. I'm sure I'm sorry, but demand for Teslas is going to rapidly shrink.
It already is.
Year. Yeah. And I think the numbers, when they start getting presented, it's going to be bad. I think Elon's...
It already is bad. What are you talking about?
It could get worse. It's worse.
It's not bad in China. China's showing a lot of buying at Teslas, though.
Is it?
Yeah.
I didn't know that. Interesting.
Well, as far as insurance, because they haven't released the numbers for China, but as far as insurance goes, a lot of people are insuring their Teslas in China. Yeah, and BYD as well.
Did you see the announcement by BYD that they have like cars that can charge literally like
5 minutes
to like 5 minutes? That's nuts.
Wow, look at that. Look at that.
Yeah.
All-time high in BYD. I thought I saw NIO was up today. No? Oh, yeah. NIO is always chilling down here. Yeah, BYD is definitely.
Have you seen Teslas getting into accidents and tickets in China? I don't know.
I don't know. I don't follow Tesla.
Yeah.
I don't think I'll be buying back in for a while.
Yeah, I think I'm going to stay away from... Dude, this market, it's really hard to create any content around it because literally everything changes on a day-to-day basis. So like I'm cautiously optimistic about some of the commentary by Jay Powell tomorrow, and I think the market could go up. But then I also know that the next day you could have what's his face. Next decade is up 17% right now.
How did you not know this?
I was slept most of the day.
How did you not know this, dude? This thing is up 17%. Look up the news. Look up the news.
What happened? Let's see.
I was actually going to bring this up.
Okay, what happened? Let's see.
Here it is.
Wins crucial court battle. Rio Grande. Oh, continued for clearance for construction. Nice. Well, that was easy. We already knew this was going to happen. FERC reauthorization is definitely a go ahead. So yeah, Yeah.
Good news, man. Good
Yep.
news. Good news.
Yeah.
Might be. Let's get down to this. It's like this is like the one company that I literally just bought a lot of and I just forgot about it. I mean, like I know I still have it, but like I'm just
That's what you're supposed to do with companies like
Yeah.
this.
I know, but like with this one, it's like just gonna leave it. I already know we're good, so
Yeah.
we'll see.
Yeah.
Zero or hero.
Yeah. I'm bullish on VG. I think Venture Global still got a lot of room ahead of itself because there's a combination of a couple of really big tailwinds that they have. Number one, they have Plaquemines, which is just generating so many cargoes right now, and the price of natural gas is actually not bad. Let me just bring up TTF USD.
And then after this, one more thing, and then we're gonna close this one out.
Yeah, yeah. Okay, so let me just share this screen. Okay. So if you look at this, reset the zoom. This right here is the spread between Henry Hub and Europe and Asia. So if you look at this, let's just look at Dutch JKM. This is the futures price for Korea and Japan. So right now the spread is almost $11. So that means that in the US you would get Henry Hub for $4, tack on about 1.15% for liquefaction, like for the product fees, and then you put on another $2 and some change for liquefaction. So it ends up costing you about $6 per MMBTU, and you would be able to ship it to China, to Japan and Korea, whatever, and you would basically get $13, right? So right now it's basically every cargo is almost a little bit above double, and as long as this stays at this pace, Venture Global is going to make a really good amount of return, right? So this is for that, and it's usually tracks pretty closely with Europe right now because of the the what is that thing called? The Russia-Ukraine war. There was a point where the Russians were importing a lot of natural gas to Europe, and that was causing prices in Europe to kind of come down. But right now, you can see here the spread between Europe and the U.S. is around the same amount. The other thing is the Europeans, their storage of natural gas has actually gone down significantly, so they're going to need to really up their shipments over the next couple of quarters to get back into compliance. This was a really bad part when natural gas prices had actually come down, because a lot of people weren't using a lot of factories and stuff during COVID. So MMBTU prices were literally $1 for here in the US, and at $1.71, and in Europe it was $1.23. And when Russia invaded, that whole matrix got screwed over. And you can see here at one point, literally you can buy gas in US for like $9, and you would be able to sell it into Europe for like $60. Crazy amounts. So right now what we're seeing is this sort of this equation, this spread between the two kind of maintain. And if Venture Global can maintain this for at least a couple of years, they're going to be able to generate a lot of EBITDA that they're going to be able to use to probably in the short term buy back shares. Like I'll discuss that further on Cash Flow Chronicles with Matt one of these days. But I'm long on Venture Global. I think they've got room, they've got capital, they can do what they need to, and
I got to look into that. I haven't had a chance to, and I should probably check it out right now because it seems like a much better price to buy in than when I was originally going to buy them. But yeah, man, we'll see. I mean, as far as non-tech, probably a good place to put your money in, especially when it comes to commodity.
Well, the thing is, there is a couple of challenges that we could end up seeing in the future. One is that the Russians have built a pipeline directly into China, so China's been getting a lot of cheap natural gas from the Russians. The Europeans would be stupid to buy natural gas from the Russians again and basically rearm them. But I think that's something that, we don't have to worry about in the short term, but in the long term, we could face. There's a lot of complexities that are in the natural gas space, but Venture Global, I think, has the ability to navigate it. So I think in terms of like total shareholder return, we could see some major shareholder returns, especially even if you're looking at it from an enterprise standpoint. If you're generating a huge amount of cash, you can use that cash to buy back shares, especially when the price is depressed this much. And insiders have been buying a lot of shares recently. So literally,
Yeah,
the
that's
last
something
like
that's
5 or
been
6
pretty
days.
interesting to me. I mean, there's a lot of companies that insiders are buying, but when it comes down, like they aggressively buy, like that kind of means something. I think it's a bit different. Like companies, people just like buy over time or whatever. Maybe a price suppressed for quite some time, but like just the degree of buying after it drops like this is like
Yeah.
kind of telling. Last thing I wanted to talk about is this. So some of you guys probably already know about this, but Grab is in the talks. The people who were quoted or the people who were referred to in the article that came out, it was actually multiple articles. We've seen this happen before, where they're in talks again. I wouldn't buy Grab based on rumors that they might be they might be acquiring GOTO, but GOTO is like they're basically Grab's biggest competitor in Singapore and Indonesia. But Singapore is where most of the revenue from Grab comes in. It's one of the fastest growing and largest countries in Southeast Asia, so that is the hot market. But GOTO is directly competitive with them across all the verticals. So GOTO is probably like a third of the size of Grab, so there definitely is more. It probably would be an acquisition versus a merger, if anything. But the talks have always been on the table and taken off the table and so on. But in this case, they've appeared back so many times and saw a little bit of a rally today. In fact, that's probably the reason why I'm not read that much today because of Grab. Well, also it's next as well. But keep in mind, Grab does have about $6.5 billion on its balance sheet. So it has the money, it can afford it. And they are a profitable company, so they can afford it. And they are cash flow positive, so they can afford it, right? So it's not like they have a lot of optionality, and they can also issue shares in order to acquire them and so on. There's many ways they can do this deal. But that would definitely be really good for Grab because it kind of create like a pseudo monopoly because there would be a lot of inorganic growth, but at the same time, like they would literally own most of the market. And kind of reminds you of like Uber and Lyft per se. Like Grab and GoTo had always that like kind of battle with each other, Uber and Lyft. But Uber, or the Grab, or the Uber of Southeast Asia is the leader, right? So without a doubt, is the leader. They have the most market share. So if they acquire Lyft, or if Uber acquires Lyft, that is like, I don't want to say that's extremely bullish, but like, well, that's good news. That means that they don't really have a competitor anymore. So we'll see what happens with that one. Grab is growing about 17% year over year. And the reason why they didn't do so great last quarter in terms of the price is because of the dollar headwinds. And what have we seen happen in the last couple of months? We saw the dollar take a plunge and the Singapore dollar come back pretty nice. So keep an eye on that one. Still intact. That thesis is still intact. Are you excited for Carnival earnings? We'll say
yes,
that one.
I am.
Okay, fine. Go ahead. You can see.
Yeah.
Don't say
am.
any. Don't say any details.
Yeah, I'm excited. I think Morgan was it JP Morgan said there's no slack in cruise demand. I don't think that there's any slack either, so they should be fine. Yeah.
So let's see here, because Norwegian was actually upgraded yesterday.
Yeah. By the way,
JP
Canada does have a lot of natural gas, but Canada's they just have a lot of liberal policies that won't allow it to ever become a big thing. Canada's biggest issue has always been their uber liberal philosophies on certain things. And so, it's like the dumbest thing. There's people in India, in other parts of the world that are burning coal, that are burning way higher levels of carbon producing, fuel sources. So if you're able to supply them with cheap natural gas, that's less emissions. But the eco warriors will always say, no. We don't want to do that. We don't want to invest in that. We want to use green technology. And it's like, you're not going to convince the Indians to adopt green technology that's far more expensive than what they're currently dealing with right now. So the goal should always be make things that work and push that. So yeah, I bet big on coal because of Monish Pabro. Yeah.
China buys a lot of coal, so that might be good too.
Yeah.
All right.
The US wants to start doing more coal as well. Maybe
We'll
coal's
always
the
be
play.
above it. Burning
Coal's
fossil
the play.
fuels. They will always be burning fossil fuels for quite some time. That's never going to go away for a long time, guys.
Yeah.
All right. Well, that about does it. Thank you, everyone, for watching. If you're tuning in from Twitter, thank you for tuning in. We do have a YouTube channel. That is this channel right here, youtube.com/@HiddenEdgePod. Glad to have you guys on there. Don't forget to like and subscribe to the video. Do these about once a week. Maybe we'll kind of turn up a little bit, man. Maybe we'll turn up a little bit. All right.
Yep.
Take care, guys. Have a good one.
Later. Have a good one.